Wade Sandy. I am the current chairman of the Tax and Legislative Affairs Committee. I'm with Eide Bailly, where I am a partner in charge of our construction and real estate group. With me is Jeff Kummer. Jeff is the managing director of Deloitte's National Washington Tax Office. And Jeff has graciously agreed to give us some insight as to the Inflation Reduction Act, which is being signed today by President Biden. So welcome, Jeff.
Thank you, Wade. I really appreciate that. It's nice to have a chance to chat with you all today on this podcast. And I thought what I would do is try to provide a little bit of a history of how we arrived here, because the genesis of this story, the conclusion of which will occur when President Biden signs the Inflation Reduction Act into law a little bit later this afternoon, August 16th. But the genesis of this really goes back to last September. So I thought maybe I would kind of touch on some of the steps and sort of the what has transpired in the arc of this legislative conversation that has been occurring over the past 11, 12 months or so. And then I'll summarize just briefly some of those key tax provisions that are included in the act. And then I'll close out with a couple of observations on where I think we're going on a tax policy journey over the next few months. And there are still some tax items that need to be addressed potentially as part of a year-end legislative package. So I'll provide a few thoughts and ideas on where we think that is headed ultimately down the road. So with that as just a couple of points to get us started, again, as I mentioned, the genesis of this conversation really goes back to certainly when President Biden was elected and his first budget that he released from the Biden White House and the Treasury Department. But I kind of view the starting point of this last September 15th, and that's when the House Ways and Means Committee approved about $2 trillion worth of tax increases that were designed to help offset about $3.5 trillion worth of spending that congressional Democrats were trying to move through via a budget reconciliation process. If you've been following this over the last few weeks or few months, you're probably familiar with budget reconciliation. It is a set of parliamentary procedures that allows the majority party in the Senate to effectively not need any votes from the minority party and still pass legislation on a simple majority basis. So this process really goes back to September 15th, and we think about where we were. The House Ways and Means Committee approved an increase in the corporate statutory tax rate. There was an increase in the top marginal individual tax rate. There were increases in capital gains and qualified dividend income rates, changes to estate tax planning rules that would have raised revenue for Treasury and been detrimental from an estate planning perspective, as well as a lot of other tax increases. And again, that was designed to pay for a pretty significant spending package. But even then, we started to see the significance of what happens in a United States Senate when you have 50 Democratic members and 50 Republican members. In that narrow majority that Democrats have, they have control of the chamber, but no additional votes. They can't afford to lose a single vote, recognizing that no Republicans were ultimately going to vote on this tax and spending legislation. And so even then, you started to see a handful of Democratic senators begin to influence the process. Senator Manchin from West Virginia, Senator Sinema from Arizona started to comment and make the point that this $3.5 trillion, $2 trillion tax increase package, far too big. It was going to have to get smaller. And ultimately, we saw throughout the process of these discussions, the House in November did approve the Build Back Better Act, which was about $1.75 trillion over 10 years in spending, about $1.5 trillion worth of tax increases to go along with that. And then we really began a long sort of torturous journey, if you're a Senate Democrat, trying to get the Senate to yes on this tax and spending package. A lot of debate going on back and forth all through the spring and into the summer. And then finally, on July 27th, right when it looked like congressional Democrats would be unsuccessful in using budget reconciliation to pass a legislative package, Senator Schumer, the Senate Majority Leader, announced, along with Senator Manchin, that they had a deal. Senator Manchin had been sort of the lone holdout, insisting on changes. And suddenly it looked like things were going to move forward. That was on July 27th. And again, a much smaller version of what even the House had approved. Now about $750 billion worth of tax increases in spending and some deficit reduction in there for good measure. And so it sounded like things were going to suddenly move forward and the Senate was going to pass this. But then Senator Sinema, because again, the 50-50 Senate, every single one of those Democratic senators can exert leverage and use that value of that vote to insist on changes. Senator Sinema stepped in and said, well, I think I can get there, but I'm going to need some changes. So there was a provision in this agreement related to the taxation of carried interest, particularly important to private equity and hedge fund, allowing that income to be taxed at preferential capital gains rates rather than ordinary rates. She insisted that it be dropped. She insisted on a few other changes as well. And again, as the 50th vote, those changes were accommodated. A couple of modifications were made to the agreement, and ultimately the Senate then did pass it 50-50, with Vice President Harris being the tie-breaking vote. The House then came back into session and approved it again on a largely on a party line vote last Friday, and then the president will sign it later this afternoon. So this has been a long sort of evolutive process, if you will, that congressional Democrats, a journey that they've been on to finally get this legislation to the president's desk for his signature. Now, as we think about the tax provisions that are in here, I would think sort of a couple of different buckets. The first one is that it does have some tax increases to pay attention to. Now, some of these are really limited more to large multinational corporations, or certainly related to publicly traded corporations. So maybe not as significant in the construction space, but there are a couple here I think that are worth mentioning. The first one is, again, this corporate book minimum tax. Essentially, it is saying there are big companies out there that maybe their effective tax rate ultimately ends up coming in under 15%. This would top it up. It's based, however, on financial statement income. So it's taking a book concept and applying it to income tax principles. And according to the Treasury Department, it is not expected to impact more than a couple of hundred really large companies. But a lot of larger companies are modeling and trying to figure out whether or not that may affect them. The provision that was added at the very end of the process, a couple of them, when Senator Sinema insisted that carried interest be taken out, is a 1% excise tax on corporate stock repurchases. Again, this applies to publicly traded corporations, but it is a 1% excise tax on those stock buybacks that a corporation does during a given year. On the partnership side, there is an extension of current law under 461L related to excess business loss rules. So currently there are limitations: $250,000 for a single taxpayer, $500,000 for joint filers, on the amount of excess business losses that can be carried forward into a future year. And this limitation was scheduled to expire at the end of 2026. Now it has been extended for 2 more years and won't expire until the end of 2028. The Superfund excise tax, again, maybe not directly impacting construction industry, but maybe an ancillary impact as suppliers and chemical manufacturers have to take this into account. But they're reinstating for the first time since I think 1994 the Superfund excise tax. So something to think about there. So that kind of covers the tax increases. Now, on the incentive side, what congressional Democrats are really focused on is a significant amount of spending in the tax incentives space related to clean energy and energy production. There are 4 sort of large buckets and a couple of $100 billion worth of tax incentives here available. And some of it is extending provisions that had expired, but otherwise were part of the law related to production tax credits for wind and solar and geothermal energies. But there's a number of provisions now related to manufacturing, designed to assist companies in accelerating U.S. manufacturing of solar panels and wind turbines. It's an advanced energy project credit. There's transportation, clean energy, clean commercial vehicles, domestic production of biofuels. There's more related to electric vehicles going forward there. There's also hydrocarbon and carbon capture tax credits available for those industrial facilities and power plants. And then renewable energy, as I mentioned, emission-free electricity generation and storage provisions. And there's also an extension of a handful of provisions that otherwise had expired at the end of last year related to residential and commercial production and building. There's a home build credit there. So there are some provisions here that maybe home builders will use or that owners of commercial buildings can take advantage of that deduction and thereby maybe help convince them to move forward with a manufacturing project and a construction project, for example. The third thing that I thought I would touch on is that there is about $80 billion included in here over 10 years of additional funding for the IRS. Now, this is on top of the current allocation, the current appropriation that the IRS receives every year. This fiscal year, that number is about $12.7 billion for the year. So as I try to think about it, maybe look at the context of 80 billion over 10, that's roughly 8 a year. So if you're 12.7, that means moving from 12.7 to roughly $21 billion a year in IRS funding. Now, they have broad sort of buckets that this additional $80 billion is supposed to go to, including $3.2 billion for taxpayer services, pre-filing assistance, taxpayer advocacy, answering the phone when you call. About $4.8 billion of that is business systems modernization. $25 billion is operations support. So that's IT, development, enhancement, maintenance, security, things like that. But the bulk of this, about $46 billion of it is designated, again, a broad bucket, but designated for tax enforcement activities. That's determining and collecting owed taxes, potentially conducting criminal investigations, digital asset monitoring, compliance activities, all sorts of things related to tax enforcement activities. And I think generally, when you listen to Commissioner Rettig, when he testifies on Capitol Hill, I think generally the direction that the IRS is going, although maybe not getting there in the near term, but generally the direction is they do want to ramp up their enforcement activities, their audit activities related to 3 primary buckets: high income individuals, large, complex multinational corporations, and then really those complex flow-through entities, those pass-through entities, thinking in terms, again, of those industries, private equity, hedge funds, things like that. That's really, I think, where the service is intending for a lot of this enforcement dollars to go to, with the idea of hiring and ramping up personnel and services in order to increase their efforts related to those 3 large buckets. So there's a lot in this Inflation Reduction Act to pay attention to, maybe from a tax increase perspective, if that impacts you, but certainly from an incentive side in the clean energy space. So now, where are we headed next? Congress is now recessed and won't come back into session until after the Labor Day weekend. They will be only in really for a couple of weeks in September. Government funding for the fiscal year expires at the end of September 30th. So there will be an effort to try to fund the federal government for the next fiscal year beginning October 1st. They probably won't be successful doing that, so they'll do a continuing resolution to fund the government for a few months. This has become kind of the habit that Congress does, the process that Congress follows, which means that we could be looking after the November 8th elections, midterm elections, we could be looking at a legislative lame duck session. And the question becomes is when Congress is in town in December, they want to leave town for the holidays, and they start sort of throwing a bunch of stuff into this lame duck omnibus bill, whether any tax provisions could get included in there. And I think the answer is perhaps. On one hand, there are a number of provisions that are still expired, credits and deductions that are expired that could be addressed as part of this. There is a provision related to research and experimentation costs. Companies are required now to capitalize and amortize those R&D costs over 5 years in the U.S. for that R&D activity, 15 years of its foreign R&D activity. There's a desire to delay that provision out into the future and effectively remove that. There's bonus depreciation that is still at 100% write-off for those capital-intensive projects, but will begin to phase down to 80% next year. Perhaps there's a desire to extend that. Maybe this year-end lame duck process is a point where that could be addressed. But there's going to be a lot of activity, I think, related to this sort of catch-all bill that Republicans and Democrats both at least most of them have to support to pass. And we'll see whether a tax title plays a role in that at that point. Again, I'm sort of anticipating that will be the case, but we'll have to get a little feel for how the two political parties are looking after those November elections. We could find, again, just as a couple of quick observations, it kind of depends on who wins those elections and what the ratios of Republicans to Democrats are, or Democrats to Republicans are in the Senate and the House next year, and whether or not the two parties want to deal before a new Congress is seated in January. So that gives us a little bit of flavor, I think, Wade, for where we're headed going forward. Don't know if you have any thoughts or questions, but I'm happy to try to answer those as we finish out here.
Yeah, perfect. Thanks, Jeff. That was a great overview and a great summary. Maybe if you would comment on, I've received a lot of questions over the last 2 weeks, from people just mainly concerned about the level of enforcement that they might expect to see with the hiring of roughly 87,000 IRS agents. And if you can just comment on that, a lot of the ownership group, the types of companies that are CFMA members are, largely family-owned businesses, privately held businesses. Maybe you can just comment and give a little context of how you might see that playing out potentially.
Sure. Yeah, it is. I'm certainly getting a number of emails related to it as well. And the emails have a theme generally, which is, is an army of IRS auditors showing up at my door tomorrow? And I think the short answer is no. As I mentioned before, I do think directionally there is an intent here to increase enforcement. But the three buckets, the three areas that Commissioner Reddick is focused on is maybe not sort of bringing those family-owned construction companies into the fold, in the sense that it is, publicly traded corporations, the big multinationals, the tech companies, pharma companies. It's large, complex flow-through entities that have lots of passive and active partners and shareholders. And then it's high income, really ultra high net worth income individuals. And there's nothing in the act itself, but there is a sort of a proviso, if you will, amongst congressional Democrats that it shouldn't really result in any increase in audit activity related to taxpayers that have $400,000 or less of income. Because remember, the Biden administration, President Biden, has said none of this should impact anybody, any taxpayer with $400,000 or less. Now, there's a lot that could layer into that ultimately, could change that dynamic. But that is sort of the talking point. And then there's also the reality, I think, that the service is going to run into, which is it's difficult, as we all in the tax community know, there aren't enough tax people for the tax jobs that are available currently. And I'm thinking in terms of companies, accounting firms, law firms, faculty at colleges, the government, certainly state and federal government, IRS, as well as state level auditing boards and authorities. There's just not enough people to fill those jobs. So the notion that the IRS is going to suddenly just add 87,000 people, I'm not convinced that that's the case. I think we will see an increased effort to hire. But if their goal is to, again, deploy those individuals on complex flow-through entities, high net worth individuals, those are the hardest cases that the IRS has to deal with. So you're talking about hiring, the training timeline that is involved there, deploying them out on those taxpayers. I think there's going to be a lag. I think you're not going to see an immediate change there. And I'm not entirely convinced, even though that is the goal. Again, given the labor pool today, I'm not entirely convinced the IRS can even bring in 87,000 people over 10 years. And maybe just a final note, 10 years is still a long time. So that's really more like, again, about 10,000 a year, roughly, or 8,000 a year over that window. So we'll have to see. But I think the idea that suddenly folks are going to show up tomorrow and start to demand paperwork and IDRs are, on their way, I'm not quite convinced we're there yet.
All right, I appreciate that. Thanks, Jeff. And I tell you what, I appreciate your time here today, and maybe we can circle back in the weeks coming up as things progress. And appreciate your time and your update today, Jeff. Thank you much. Appreciate it.
Thank you.